Okay, testing, 1, 2, 3, testing, 1, 2, 3. The rain in Spain falls mainly on the plains. The answer France stay mainly in your bonds. Guten Morgen. Welcome to Forex.Today, the YouTube community of approximately 20,000 foreign exchange traders. We gather here today to conduct technical and fundamental analysis with the overriding goal of putting together trade plans. Let me remind you that trading is risky, long-term, and never risk money you cannot afford to lose. Hey, my name is Wayne. I'm a currency trader like you. I used to want to be an astronaut, worked for NASA for a few years, military for a day, turns out. Then I thought I'd be a businessman. So I went to the Silicon Valley and started a few businesses. One of them, 30 years later, I just recently talked to a current customer who's super happy with a company I made 30 years ago. Pretty cool, huh? So then I became a venture capitalist. That was really interesting. But then I found out what? Forex was even better. $2 trillion a day. Can't miss up on that opportunity. And I've been doing Forex now for 20 years. Pretty interesting, right? Cool. So ask questions, get involved, and I will share from those experiences. You can learn from what I've figured out, and you can learn from my mistakes. And then, of course, I'll teach you everything that George Soros taught me when I sat on a board of directors with him. He put his arm around me and he said, "Son, let me tell you how to trade Forex." Boy, that would have been nice. That was in 1995. Wouldn't that be great? Anyways. Ask questions, get involved. Also, I recommend you visit tradersway.com and open up a demo account and get on with it. Yeah, okay. So someone, I guess it looks like YouTube is freezing up. I don't know if there's anything I can do on my end that won't kill the stream. Gee whiz, YouTube. Let me just double check a couple of things. What can I do that won't kill this? I think if I try to fix this for YouTube, it's going to kill the stream. Jim says it's all good, huh? Maybe it'll just fix itself. I doubt that, huh? Well, let's give it a couple more minutes and see what happens. Maybe it'll just catch up. All right. Yeah. Again, if I address that, what's going to happen is if I adjust on my end, it's going to kill the stream. And so let's see if it'll just fix itself. Okay, so what do we have here? We have continued Aussie appreciation and, of course, Kiwi going with it. Great British pound, which is great because it was a sleeper a little bit. CAD still sort of up and down, generally still sideways. Yen up and down, generally still sideways. Dollar up and down, generally still sideways. Swissy up and down. So when you see the funders like the funding currencies here, it tells me that we're probably in the middle of no man's land between where bulls would buy and where bears would sell. And so that shows us a clear not direction. But look, yeah, we do have action here. And then Euro, probably want to skip that too, right? Cool. So we'll go through this and see what's up. Let's take a look at the poll. Thank you for participating in the survey. So most of you guys are concerned with the Fed and interest rates coming in 5 weeks. Okay, interesting. I hope you read the meeting minutes. The word inflation was mentioned 72 times. But I'll go back. I interpreted the meeting minutes the same way that we interpreted the meeting minutes last time and the time before. Okay? And it seems to me they're going to adjust interest rates, but slowly. And that they're going to reduce the balance sheet, so balance sheet reduction, more quickly. And it still seems that way to me. And the media is saying, oh my God, they're going to raise 50 basis points, 100 basis points. They're going to do this, they're going to do that. But I'm not sure where they get those opinions. That's the problem. I'm not saying they're wrong because I don't know the future. But I don't understand where they get the opinion that the Fed is going to raise interest rates very, very quickly. I get it, and I understand the argument, but we're not trying to argue what we would do if we were running the Fed. That's a fool's errand. What we're supposed to do is figure out what the Fed is likely to do. And it still seems to me, and again, this is my interpretation, that they want interest rates steady and slowly and soon. So let's say 25 basis points. And maybe the way they address the political election and still raise interest rates is that they just raise 25 basis points every single time. I'm open to that. It's either they're so consistent that nobody has to think about what's going to happen at the next meeting, and that's ideal. Or the Fed generally doesn't raise interest rates right before an election to stay apolitical. So they either, right? So like there's so many different ways this could play out. So it's really, what does the Fed say? And now I'm leaning more toward, look, 25 basis points, maybe every single meeting, just to stay slow and steady, steady and slow. But even that might be too much, right? Like we still might be at only 4 rates this year, not 7. So we have to figure all that out. But it's still, the language was more like, let's raise interest rates soon, slowly. But we got to kill the balance sheet by like trillions and trillions and trillions of dollars. And they actually, I forget where it said it, but they didn't say specifically mortgage-backed securities, but they said back to treasuries. Right? You catch that? They didn't mention mortgage-backed securities. They just said that they would rather hold treasuries only, which is, again, it's like observing a black hole. Okay? But check this out. Right? Part of their discussion was, well, why don't we just kill quantitative easing now? Let's send a message. Let's just kill QE. But what's interesting is they're still buying $20 billion worth of mortgage-backed securities this month, which is interesting. And yet they're talking about, how do we get rid of that stuff? Well, you know, a good beginning would be to stop buying it, right? Okay, here's a question. I recommended investing in high yield central banks. Okay, well, Turkey is a good investment. Well, first of all, why would you say that? Why would Turkey be a good investment? Okay, you have to understand the difference between a high growth and a high inflation country. So why would you say Turkey's a good investment? Okay. I'm supposing you're going to say because they have 20% interest rates or something. So let's talk about that while you, by the way, I actually want you to answer it. So I'm going to wait, but I'm going to continue. So Turkey, okay, Argentina, Zimbabwe. Sorry, I don't know how to spell Zimbabwe. Zimbabwe. I'm going to spell it phonetically. I'm sorry if you're from Zimbabwe and I didn't spell it. What else could we throw in there? Any other ideas? What could we throw in there? Okay, so now you're confusing something, and that's exactly what I wanted to get to. Okay. Let me throw one other in there. What would you throw in there that's similar to these three? Yeah, correct. Venezuela. Sorry, Venezuela. All right. These are all high yield. And I recommended at one point investing into high yielding central banks, right? Because you earn high interest rate. Okay. What's wrong with this idea? Okay. These are shitty economies. Pardon my French, but I'm using the swear like an exclamation point. These countries suck. Yeah. As an economy, I don't know. The people, I know a lot of Turkish people that are just fantastic. I know a few Argentine people that are just fantastic. I don't know anybody from Zimbabwe or Venezuela. Okay? These economies suck and are not worth investing into. I'll give you an example. I think that right now, and I'm just going to give a rough example, but it's not far from the truth. Okay, Argentina will pay you 20% right now if you lend them some cash. Is that a good investment? The answer is no, and why? And you're going to say risk, but what kind of risk? Well, default risk, maybe. But here's the thing. The true answer, don't worry about default risk and inflation, all these different risks, but, okay, inflation is 30%. So if you invest into Argentina, get a 20% yield, you will be guaranteed to lose money in real terms. Okay, these countries suck. They're terrible right now for investment. Okay? So you have to understand what I'm talking about. I'm talking about something different. I'm talking about growth. Okay? Countries, let's say like Australia has really low interest rates, but there was a time when Australia and New Zealand, for example, were paying, like, I think this was 7% and this was 8%. Okay? They too had high inflation, but not much more than that. But what was going on was growth. These countries were making money hand over fist. They had strong economies that produced strong jobs, that produced strong wages. They lowered their debt, and they had lots of business coming from China. And the rest of the world was willing to invest into natural resources from these countries. They were strong, healthy, growing countries. That's what I'm talking about. Okay? They had 8% interest rates because they were growing so strongly and had so much good inflation from the growth. I don't want you to think inflation is always some country printed more money than there needed to be. Literally too much money, right? This came from investors demanding these currencies and driving up, okay, values and such. Okay. So you have to extrapolate. I would never say find the worst country on the planet nobody would ever lend money to, because it would be absolutely ridiculous and even negligent, and then invest. No. There's a reason why there's 20% inflation, or 20% interest rates. because no one in the planet would lend them money. And so they'll do whatever it takes, and they're doing what it takes. But even then, it doesn't even make sense. So even at 20% interest rates, it would be a bad investment to lend Argentina money, because you will lose in real terms, where you take your how much you're being paid, subtracting the amount of inflation there is, and you're left with a loss in real terms. Okay? Yeah. So no, that's not what I meant. Turkey has a problem. Their problem is they're not doing business with the rest of the world. There's some sort of policy in the economy, either by the central government or the central bank or both, but there's some sort of policy that deters foreigners from wanting to do business there. Therefore, there's no dollars in their vault. There's no euros in the central bank's vault. There's none. So when it comes time for Turkey to pay its bills in dollars or pay its bills in euros, they don't have any. So they have to go out and buy some. Problem is, their currency is worthless. So they have to sell their currency to buy dollars and euros to pay back the loans. By the way, the loans were already taken, so there's no future growth from that money. That's all past. But the issue now is they have to sell their own currency to buy foreign currency to pay for their old loans. But the problem, of course, is then by them selling their currency, they weaken their currency further. So then another month or two goes by, and Turkey owes $100 billion in loans, let's say in dollars, literally in dollars. And so they go to the central bank, and they're like, we need some dollars. We owe $100 billion in loan payments, so we need $100 billion. And the central bank's like, what the hell are you talking about? There's not even a single dollar here. So it's like now going to the airport, and you're going to the little kiosk, and you're like, I'd need 100 billion US dollars. And they're like, okay, you got to pay a spread, you got to pay a fee, and all that kind of stuff, and you got to go out and buy some expensive currency, which means you're actually selling your currency in exchange for the US dollars. So that weakens the currency. You're selling $100 billion worth of Turkish lira, which is 158 trillion gazillion, right? So every time they do this, and of course it's on a regular basis, they lower the value, lower the value, lower the value, lower the value. Now, a healthy economy is radically different from that. Let's take South Korea. I'll just randomly grab one. South Korea probably has US dollar loans. South Korea probably has euro loans, and so on and so forth. The difference is South Korea does business with the entire world. So as Americans buy Samsung phones, what inevitably is happening? Americans are going to the central bank and saying, hey, central bank, we're going to give you US dollars in exchange for South Korean won. Okay? So now they have South Korean won, and then they buy a Samsung phone. But the central bank now has dollars. And then Europeans do the same thing. I want some Samsung. Great. So now there's euros in the vault, because the euro goes to the central bank exchanges it for South Korean won, and now those buyers have won, and now they can get whatever they wanted, in this case, a Samsung phone. So at the end of a business day, since South Korea is a net exporter, there's more foreign currency in the vault. Every single day they have more and more dollars, more and more euros, more and more pounds, so on and so forth. So when it comes time for a South Korean company, person, or the country to pay off a loan in foreign currency, dude, not a problem. They already have it. You see, There's no like exchange rate per se. They already have the dollar. So it comes time to pay $100 billion in a US dollar based loan. Not a problem. They just take it out of the vault. Here's your $100 billion. Boom. Debt's paid down. And of course, because it's a good country, that debt was probably productive. Because like a lot of people say debt's bad. No, credit, if you have a $300,000 mortgage on a $700 million house, okay, yeah, great, right? Because you have a productive asset and you're leveraged against it, but that's okay. 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 So yeah, so right, so yeah, so here, so if their tourism increases in Turkey, that would be reasonable for Turkey. Sure. Turkey is an amazing